Central banks typically lower interest rates to stimulate growth by making borrowing cheaper. This standard mechanism eases financial conditions, keeping the economy's ears turning. Recently, that mechanism failed. After the Federal Reserve cut rates, 10-year Treasury yields moved sharply in the opposite direction, spiking higher. Mortgage and corporate borrowing costs followed those yields upward, tightening the economy even as the central bank attempted to loosen it. This creates a systemic disconnect. Market participants are waiting for a return to the low-rate environment of the last decade, but the current math suggests that normal is no longer attainable. This paradox is the first visible evidence of a breakdown in global liquidity plumbing. We have entered a period of fiscal dominance. This occurs when a government's debt burden becomes so large that its funding requirements override the central bank's ability to set monetary policy. To trace this mechanical failure, we look to the entity issuing the debt, the United States Treasury. The Treasury faces a structural mismatch. It requires trillions of dollars in continuous funding, but the natural pool of buyer demand is currently insufficient to absorb the supply. The Treasury's survival tactics to secure this cash now pull against the Federal Reserve's efforts to stabilize prices. Understanding the path of the market requires mapping the exact mechanical plumbing of how the U.S. government funds itself week to week. The issue begins with a lack of demand for long-term debt. Investors are increasingly unwilling to lock their capital into 10- or 30-year bonds at current yields. To compensate, the Treasury shifted its issuance to the short end, flooding the market with T-bills. Weekly rollover volumes surged from $100 billion in 2013 to $550 billion today. The government is trapped, constantly finding buyers to pay off expiring bills. This creates rollover risk. The government's ability to function depends on the market's willingness to participate in massive, high-frequency auctions. If even one of these $550 billion weekly auctions fails to find enough buyers, the government faces an immediate funding crisis. The Treasury is now reliant on the short end of the curve, creating a rigid dependency that limits its future policy options. To manage this rollover, the government uses the Treasury General Account. As weekly volume climbed toward $550 billion, the required cash cushion expanded proportionally. Hoarding hundreds of billions in the TGA has a direct physical effect. It removes liquidity from the broader financial system. This cash is pulled directly from the overnight funding network, specifically the repo market, which serves as the primary pipeline for institutional liquidity. The TGA acts as a vacuum. By siphoning off billions to protect the government's own auctions, it drains the repo market and causes significant strain in the private funding plumbing. The Treasury's mechanism for rolling over its own debt is siphoning away the liquidity required to keep the private market stable. Despite the shift to short-term bills, the government still needs buyers for its long-term bonds. If traditional investors are gone, we have to look at who is filling that gap. The marginal buyers of long-duration debt are now highly leveraged hedge funds executing what is known as the basis trade. Federal Reserve data shows that since 2022, these funds have purchased 37% of net longer-term Treasury issuance. These funds do not invest for the long term. They use extreme leverage to profit from tiny differences in price between different segments of the market. To maintain this leverage, they must borrow billions of dollars every day from the exact same overnight repo market. This makes the buyers of long-term government debt entirely dependent on the short-term liquidity pipeline. The Treasury relies on these hedge funds to absorb its debt, yet the Treasury's own TGA cushion is siphoning away the liquidity those funds need to function. This creates a direct collision. The Treasury needs cash, which starves the repo market, which the hedge funds need to finance their bond purchases. As the TGA pulls liquidity out, repo borrowing rates begin to spike. When borrowing costs rise, the leverage becomes too expensive to maintain. This forces hedge funds to immediately unwind their positions, a process called degrossing. This unwind triggers a mass sell-off, dumping nearly $1 trillion of long-term treasuries onto a market with no natural buyers. This massive supply dump sends bond prices lower and forces long-term yields sharply higher. This is the snake eating its own tail. The Treasury drains liquidity to protect its auctions, which breaks the funding for its marginal buyers, causing yields to spike and creating the very crisis the Treasury was trying to avoid. In this loop, attempts to manage the debt through traditional policy only tighten liquidity further, accelerating the systemic pressure. While these mechanics are hidden in the plumbing of the repo market, They produce visible warning signs elsewhere. Bitcoin serves as an early source of liquidity for the global system. Because it is a 24/7 market with no gatekeepers, it is often the first asset sold when institutions need to raise cash quickly. When repo rates spike and liquidity tightens, Bitcoin experiences a sharp sell-off before traditional markets even open. It serves as a smoke alarm, signaling that dollars are physically disappearing from the funding pipelines. These drops are often misread as standard volatility, but they are actually early indicators that the sovereign plumbing is beginning to fail. Foreign central banks have also recognized this breakdown. They see that the US Treasury market can no longer provide a risk-free liquid reserve because its own internal mechanics have become too volatile. The 2022 weaponization of foreign exchange reserves confirmed these fears, forcing sovereign nations to find a different way to store their wealth. Central banks are now rotating away from US debt and recollateralizing their balance sheets with neutral, non-counterparty assets. This massive rotation explains why gold has reached new highs even while the US dollar remains strong. Until the mechanical mismatch of this debt plumbing is resolved, traditional rate cuts will only result in currency debasement. In a loop where the system cannibalizes its own liquidity, neutral reserve assets are the only logical exit.